Hello, dear Piotr. Thank you for accepting my invitation and for being here to record one new podcast in our series. So first, I would kindly ask you to give us a few details about you, your work in Warsaw, and the involvement in our Fintech Horizon 2020 project.
Hi, Vasile. Thank you for the invitation. This is great to be here. I'm working in the University of Warsaw. I'm the assistant professor in the chair of quantitative finance. But I also head the data science lab. I group together young enthusiasts of data science, machine learning in various applications. This group consists of my students, master students and PhD students. And we basically do research together. We do some academic projects, papers with the use of machine learning and AI, mainly in two fields. Like we operate in the field of quantitative finance and also regional science. And the works which we do in quantitative finance are closely related to the project which we have, the Fintech project, as we basically analyze data related to peer-to-peer lending, some algorithmic trading strategies based on advanced tools. We also plan to apply for the scientific project related to the use of reinforcement learning and explainable artificial intelligence in finance. So it very closely relates to what we do within the FinTech group.
Okay, thank you for the details, Piotr. And since I see that you have a lot of expertise and a broader array of things in the field, I would go further with probably you've noticed that bringing technology and AI into the financial sector has been enhanced lately by the pandemic. So what are the main trends that you have spotted regarding the use of AI in this sector in the last period?
Yeah, that's true. The epidemic situation in 2020 and all those constant lockdowns for sure boosted the demand for digital services powered with artificial intelligence. Basically, the COVID pandemic, I would say, accelerated the digitalization of everything. We all cope with remote education, remote work, remote shopping, right? So it also is no exception for financial services. And I would say that, in my opinion, financial technology played a critical role in kind of reducing coronavirus risks. So that's what I observe as main trends, especially in Poland. I would say that those risks were mainly related to exchanging cash. So we observed accelerated abandonment of cash, right? Cashless payments were developing very, very fast. Of course, they were around for a long time, but many people were still afraid of those cashless payments. But during the COVID, this topic was brought to the spotlight again. So people were fearing using cash, and that's why many consumers resigned or significantly reduced paying with cash. Nowadays you don't need to take a wallet with you to shop, so it's very convenient. We all wear smartwatches or have our smartphones with us. Paying with those applications or tools is fast, convenient, and safe, I would say. So that's one of the most important trends. Another trend which I observed in Poland related to helping small and medium enterprises, which had a lot of trouble. So somehow the solutions offered by fintech, I would say, protected those companies against the economic downturn. Right, it's basically maintaining liquidity proved to be a huge challenge for these companies in those uncertain times. And I would say that financing offered by fintechs turned to be great help for those companies, especially those small and medium enterprises, which usually have much less capital on their disposal than the large entities. And basically, those small and medium enterprises were able to get support much easier, like quickly. The support like credits which do not require an excessive bureaucracy or allow for cash pickup within 24 hours, right? So small business owners, like all the restaurants owners, did not have to wait for the contractors, let's say, to pay the invoices. They could get like some small credits or support faster, and they were able to pay their current costs, therefore, or maybe invest in their development, or just to keep the employers, right, quite well. So the entire process of obtaining this simple financing from fintechs is very simple. All is done online. Money can be obtained based on the history of flows from the last few months. So the automation of the process of assessment of those companies and the risk related to this needs to be automated. So I would say fintechs are more and more entering the market in here, convincing customers also to use the cashless forms of payments. So these will be the two main trends which I see. I don't know if they fully relate to fintechs, but of course also the e-commerce is the industry which will benefit the most from the pandemic situation, as we got used to like making all the shopping online. But this is like slightly related to fintech. So that's what I see as the main trends of the last year.
Okay, thank you very much. Yes, we've all noticed those trends, and persons that were totally against buying online, as you've noticed, have started to consider this. Okay, everybody buys online now, like so. It became very accustomed with a lot of customers which had something against it or did not consider the option as viable. And now I would like to go further and link back with the research, with our project. And I would like to know your opinion, or how far do you see it's the academic research, since also the last year allowed for a lot of academic research in this field, and the practice. So how far do you see is the academia and the practice? So what's the road from research to innovation and practical implementation, at least Poland or Europe? What's your take on this?
Mm-hmm. Yeah, that's a very good question. I must say that I know that there's a growing awareness in many industries that kind of statistical modeling or using advanced machine learning or artificial intelligence tools is a very powerful tool that can enhance the company's analytics and then give many practical applications. I can see that more and more companies find how the automation of the process of analytics is important, and smart data analysis, let's say, especially in the era of big data, where the amounts of data and the form of the data, which is usually unstructured, doesn't allow to easily analyze this by humans. So this is not only the pandemic situation, but I think also the development of friendly software, which allows to apply all those tools easily, which give access to cloud computing, like somehow lowered the entry threshold associated with those, with the use and implementation of those tools. There are many ready solutions that can be easily applied in many companies. It not only relates to finance, to fintech companies, which are much ahead of financial sector is one of the most digitalized in here. This is much ahead of any other sectors. But I may give you examples from my own perspective, my own experience, which I hope will be interesting here. So research, in my opinion, research and practice is not far away from one another, especially in recent year, where this digitalization process has fastened. And it also fastened the cooperation between, I would say, universities or academia and business, but also public institutions, right? So apart from the research projects which we are involved together, I also take part in two research and development projects which started in recent year. So I think the pandemic situation strongly influenced this like the like probability of starting such projects, and they are done on the edge of academia and business. One of them is the business project, and the other one is done with the public sector. Both are financed by the Polish National Center for Research and Development. And the first project relates to marketing automation. So basically, together with the one of the leading digital market providers in Poland, my university, my faculty, and I personally developed machine learning and artificial intelligence tools to automate the marketing process, to model conversions, clicks, sales based on a click stream. So that's what like, the companies which operate online collect a lot of data, and this data has to be carefully analyzed, and that's one of the applications. So I think this process has sped up. And the other project which I'm also involved in, which is also performed by my university, my faculty, and one of the public institutions in Poland, relates to the automated detection of tax frauds. So we built models that on the individual level of small and medium enterprises analyzes the risk of tax frauds based on massive data collected by state tax authorities. So I think that especially recently, when, as I said, the awareness of this methodology has increased, and when the whole world went online, things such like close cooperation between research and not only business practice, but also, I would say, state practice is becoming very, very close to one another.
Thank you, Piotr. So now I would like to go a little bit deeper and start discussing more in depth the research that you do. And I would continue with one of your papers, the impact of the content of Federal Open Market Committee post-meeting statements on the financial markets, text mining approach, which is one of your latest papers. So I would like you to give us a little bit more details about what's the main idea, what are the main findings. So what's the paper about, basically?
Yeah, okay. This is the paper prepared jointly with my master student, Ewelina Osowska, who, by the way, won the prize for the best master thesis just recently for this paper. This is the master thesis prepared in the form of a paper. We have the opportunity to write to jointly prepare master thesis written by the student and the supervisor, and it can be prepared in the form of a scientific article. And the paper here relates to the analysis of how the statements of the Federal Open Market Committee influence the financial markets. We all know that information or news released have strong impact on stock prices, on currency rates, on the foreign exchange market, and that's what we analyze here. We check if, apart from the and we know that the unexpected news influence the market most, right? As there is an adjustment immediately in theory. But of course, it's not always immediate, right? So what we analyze here is we examine the stock market, so S&P 500 index, and the foreign exchange market. Here we look on the most liquid currency per euro versus dollar, and we check how it relates to, how it reacts to the publication of the post-meeting statements of the FOMC. As basically not just the news, but also like some kind of comments which are prepared by the Federal Open Market Committee have impact on that. There's been a lot of research before about that, but what we do, what is new, we apply machine learning tools which assume some kind of non-linearity of fractions. So we apply some algorithms which try to uncover and hide the shape of relationship between the information, like the tone, or you can say the sentiment included in the statement, and the reaction of the markets just afterwards. We analyzed data for 14 years, starting from 2006 up to 2020. There are about 8 meetings of FOMC every year, and we analyzed data just after the publication of the statement. So 1 minute after, 2 minutes after, 3, 4, up to say 10 minutes after. We also look on the reaction before to verify if there's any like indication of the insider trading. In addition, apart from the market surprise component, so the difference between the expected, say, interest rates and announced interest rates, we also use 2 financial indicators, purchasing managers index and the consumer confidence index, just to take into account some kind of the assessment of economic situation by consumers and by producers. And what we find is that in both cases, both in the stock market and in the foreign exchange market, the reaction on the news is almost immediate, but slightly faster in the foreign exchange market, right? So it's interesting that we can explain about 30% of the returns just after the event using our model, using information which we take into account. And in case of foreign exchange market, the reaction is more or less up to 3 minutes, while in case of the stock market, it's up to 4 minutes. That's interesting. And we found that the tone of the statement, and we analyzed this with the specific dictionary, financial dictionary, which is used in such analysis, related to the like words or phrases used by central banks in their announcements, which are very specific. We found that this tone is an important factor explaining the returns. And what is more, we also found that using nonlinear machine learning tools helps to explain more and predict better the returns related to this unexpected news. So we are almost done with the submission of this paper to one of the top journals related to monetary economics, but we also have an idea of the like continuation of the further step. Like Evelina is a member of my data science lab group, so we closely cooperate together still, and we think about like creating and backtesting a trading strategy, algorithmic trading strategy based on those predictions which we observed for financial markets in this paper.
Thank you, Piotr. Very interesting. And I would like I know that you're working on another paper with HIP-FAM and its application of machine learning models for automated investment strategies in consumer loans. And if it's not too early, I would like to ask you to kindly give us some details about the same. What's the main idea, what you found until now, and what you plan to do in the future?
Sure. Yeah, that's thank you. That's a paper which we also developed within the data science lab. And of course, both papers, the previous one and this one, are closely related to our fintech project. And both are like partly financed. I mean, the research here is partly financed by our project. So yeah, this is a very important piece of work for us. And the paper written with HIP-FAM relates to peer-to-peer lending. So we analyze the data of the Lending Club, the largest peer-to-peer lending company in US, and based on the data which they provide, we predict the probability of default of consumer loans using various machine learning models, including random forests, neural networks, XGBoost, some other boosting algorithms like CatBoost, K-nearest neighbors, naive-Bayes. So a lot of various models, but prediction of the default is not is just the first step, right? So based on the predicted probability of default, we want to create a portfolio of loans to invest in, right? So we assume that the external investor might assume to invest in several loans to get profits. So the second step is to create a kind of selection algorithm which allows to like indicate which loans we should invest in to get the highest profits. So basically, one of potential investment strategies would be just to invest in the loans which have the lowest probability of default. However, in this case, they might be the loans which have low interest rates, right? So although the risk is low, also the returns will be low. Therefore, of course, on the other extreme, we can select only the loans with the highest interest rate. But those could be much more risky in turn, right? So they might have a high default probability. So what we do, what's our like novelty or value added here? We propose a metric which takes into account both the interest rate of the loan and also the probability of default into account. So that's a combined complex measure, which we call the expected return on investment. And we use this to rank the loans from the most from the most promising to the least promising. And then in the next step, based on that measure, based on the ranking, we select, there are some like different thresholds. So we select top 10% or top 20% of the loans ranked by the highest expected return on investment, and we check what's the weighted profit of those loans. And of course, we compare it with some simpler selection strategies. So with the strategies which rank the loans based on the lowest probability of default, or based ranking them based on the highest rate of return, or just selecting randomly, right, 10%, 20%, or 30% of loans. And what we observe, like our initial results, show that whatever we take into account, our portfolio, the portfolio selected based on our metric, outperforms all the other strategies in terms of return and risk. So this is still to be finished, but it's on the, I would say, final stage. What we also consider as further steps is trying to add some additional constraints, like for example the loan purpose. So just select loans which have the same or various purposes, right? Or take into account the annual income of the borrower to make some additional selection constraints. Of course, in case of data for Lending Club, we only have the data on the total amount of loan. In this case, in the case of our metric, to enhance it, it would be useful to have data on the cash flows of each loan. So showing not only whether it was paid or not, but how it was paid month by month or year by year. That will allow us to more properly calculate the, say, some kind of internal rate of return measure. But unfortunately, it's not available. So that's the limitation which we need to somehow accept.
Thank you, Piotr, for the very interesting details. We've discussed at the beginning the main research and development directions in AI. Then you gave us some very interesting details about your work, the research that you do. And before closing, I would like to ask you, what do you see in the use of machine learning and artificial intelligence in finance for the next period? So what would you say are the two, let's say just two hottest directions for the next year? What do you see like the rising stars? What are the two trends?
Okay, so I think that the pandemic situation will like permanently change the habits of customers, and most of us will just love to be still online to like have access to digital services. And I would say that everyday life in the internet will concern the use of like online payments and online financial services. So maybe I'm somehow biased into my experience also in business. For almost 5 years, I also worked as quantitative analyst in the American hedge fund, like trying to create and backtest algorithmic trading strategies. But I would say that one of the rising stars could be the like industry of robo-advisors, right? So currently we observe that interest rates are very low, right? We don't get any like interest from banks. It doesn't make sense to put your money on bank accounts. And looks like the zero interest rates would stay long with us. So we should look for alternative investments. And basically the financial literacy of most of the population is very, very low. Like people don't understand finance, and I would say that financial products also become more and more complex. From the other side, like many people, like young people, but also like we are still young, of course, as well. But for young people, they like they are not afraid of internet technologies, right? They are digital natives, and they will seek for some opportunities for investments, and that's why I think that robo-advisory, some kind of personalized portfolio management and financial product recommendations, which takes into account individual characteristics of clients, their financial situation, risk appetite, their aims for investment, their current investment habits, offer advice, and then manage the portfolio. I think that will develop quite fast. At the moment, robo-advisor is still a kind of hybrid between the fully automated and human analyzed process. But I think this tools will be refined and become more fully automated, like using some self-learning algorithms, maybe those like reinforcement learning, which is one of the great tools that is still not used that wide. So that's one of the I would say one of the stars. And as we all move to the internet, I must say that security is another like important problem and rising star, right? Further development of machine learning and AI-based tools requires transparency and trust, right? And trust is fully connected or related to reliability, but also security, right? We leave a lot of sensitive data online, and financial services providers collect this data, analyze this data. So we need to be sure, customers need to be sure that these data are safe, that their privacy is maintained. And as more and more like such services are offered online, there's also a risk of cyber attacks, right? So cyber attacks get, of course, more and more sophisticated. So I would say cyber security and development of tools which allow to like better control for that, like for example, the blockchain technology is another like rising star, right? So I would say robo-advisory and wide understood security are the most important like trends that will develop in the next years. And if I may just add one small comment, I think that also like personalized customer experience is also something we got used to, right? So this is not maybe related directly to finance, but I would say that the development of chatbots, all those automated communication tools will also have their scene in the next few years.
Thank you very much, Piotr, for the very interesting discussion. Thank you for your time and for sharing this insights, your thoughts with us. And I hope we'll have a lot of viewers to this video. So thank you again and enjoy the rest of the day.
Thank you, Vasile. Same to you.